If you would have just given me 30 days a month ago, your trading would be unrecognizable today. But you didn't, because you've made a bit of money in the past on your own, but then you lost it and then repeated the cycle without ever knowing how to fix it. That's because money does not change you, it exposes you, which is why the more money you make in the markets, the more and bigger the mistakes seem to be. And it's showing you not that you're better or you're worse, it's just that you simply have not prepared the right way or enough. So let's figure out why that happens and how we would fix it together if I were your mentor. Now, we have to understand that money or making money does not introduce new behavior. What it does is it increases the visibility of existing behavior. As position size grows, as every single habit already present in the trader's decision-making system expresses itself with greater impact. And so small deviations that were previously tolerable become consequential. And so early in development, the mistakes you make often remain hidden because your risk errors are small. Rule violations produce very limited damage. And because these outcomes are muted, the trader receives feedback that isn't quite as pronounced. And so this allows these unstable habits to persist without an immediate consequence. And so profitability at small size can occur even when behavior is inconsistent. But as capital grows, as money grows, those same internal processes operate under higher stakes. And so your confidence is still going to rise after wins, and risk still adjusts in response to recent outcomes. But the rules still soften during comfort, and this difference is magnitude. Every single deviation from your plan, from your strategy that was previously unrecognizable now carries a much greater cost. And therefore, the mistakes you make seem larger, but they are not new. And this creates the illusion that money changed the trader. But in reality, money removed the margin that previously absorbed all those poor habits at the beginning. The system is now visible and transparent. So what looked like skill at smaller size is revealed as incomplete preparation for exposure to variance at this massive scale. And the trader interprets these larger mistakes as psychological failure or loss of control. Now, this interpretation misses the mechanism of this entire process. The behavior was always there. It simply lacked enough exposure to show us its full effect. And so higher profits did not create this issue. They provided the conditions for it to come to the surface. And so preparation in this context refers to behavioral stability under increasing exposure. Without a repeated experience managing risk, rules, and inactivity across a wide range of outcomes, the internal learning system remains incredibly fragile. And so when size increases, that fragility becomes measurable. And that's the core of what we would work on together, because the market does not punish success. It amplifies whatever structure is already in place. And so if habits are stable, scale is survivable. But if habits are unstable, scale accelerates failure. And so the increase in mistakes is not a reversal. It is just a clear signal of what was never fully built at the beginning.